Yeah. All right, welcome everybody. Thank you for taking time out of your busy days to join us for the latest in our ongoing series of oil market conversations. I'm Mark Finley. For those of you who don't know me, I'm the fellow in energy and global oil here at the Baker Institute's Center for Energy Studies. As I mentioned, many of you know already that we've been doing a series of oil market conversations. We had one just last month talking about soaring gasoline prices, and where that was coming from, including some discussion about the tightening global refining situation. Part of our commitment with the pandemic has been that we should provide some kind of current market commentary and coverage because oil's kind of been in the news, in case you hadn't noticed the last couple of years. Just recently, it's making daily headlines. Soaring prices at the pump, although they're now beginning to ease, good news for drivers out there, along with crude oil prices, which have been weakening. We've seen, massive uncertainties around Russia's exports of both crude oil and refined products. Not just uncertainties about how much is being exported, but where it's going. We see monthly meetings of the so-called OPEC Plus group. And we've seen record cash flow for U.S. oil producers and refiners. We've seen that this has attracted a lot of attention in Washington, D.C., where I'm based. Just in the last couple of weeks, President Biden has noted that oil companies are making more money than God, which I thought was an interesting observation. And having been raised as a Roman Catholic, I know how much money God makes. He's now potentially visiting Saudi Arabia in the next few weeks, with prices at the pump looming very heavily. We know that prices at the pump have his attention. Just today he's requesting that Congress pass a 3-month holiday on the federal gasoline tax of 18 cents a gallon. Why all this attention? Because it matters. And I'm not telling you anything you don't already know, I'm sure. Both as drivers and as many of you from working your careers in the energy industry. Prices at the pump and prices of oil and refined products like gasoline and diesel fuel matter massively for consumer pocketbooks and confidence as fears of a recession are looming. Gasoline alone recently has accounted for 20% of all of the CPI inflation in the U.S. economy over the last year. It has implications for geopolitics and national security, as we're seeing playing out in the aftermath of Russia's invasion of Ukraine. It matters for politicians' approval ratings and election prospects in an election year. So where do we stand today in the oil market? And where are we going? We're fortunate to have a great panel to discuss. Their bios are on our website, and I won't read them to you. But briefly, we have Clay Seigle, an energy strategist and vice president of the U.S. Association of Energy Economics, who will be hosting their conference here in Houston in a couple of months' time. Clay will lead us off talking about how global crude and refined product flows are adjusting in the face of all of this uncertainty. Joining us remotely from London, we'll have Herman Wang, who's managing editor for OPEC and Middle East News at S&P Global Platts. Herman will talk to us about OPEC Plus production and decision-making. And finally, Ben Shattuck is Research Director for America's Upstream Oil and Gas at Wood Mackenzie. Based here in Houston, Ben will discuss how life looks from the U.S. shale patch. Each of our panelists will offer some opening remarks, and then we'll move on to a moderated discussion and hopefully your tough questions. For folks here in person, yay! Thank you for that. We will have microphones. For people online, you can submit your questions in the Q&A tab of the event, and we can read those on the stage as well. So, without further ado, Clay.
Okay, well, good afternoon. Thanks to Mark, thanks to the Baker Institute Center for Energy Studies for hosting today's event. And thanks also to my friends at Vortexa for providing the oil flow data that underpins this presentation. I guess I should also thank my daughter for letting me borrow her colorful iPad case and iPad for this for my notes. I know that she'll thank me if I remember this time to change the font size back from 50 before I give it back to her, but that's what I need. Well, there is a major reshuffle of global oil flows that's underway. And I think the biggest question for us to focus on that's really facing the market right now is in the second half of this year and into 2023, will Russian oil flows just get reshuffled around the world, or will they actually be reduced and removed to a certain extent from the global market? I think that it all comes down to this. I think that this is going to shape obviously the supply-demand balance of oil. It's going to shape price formation for months and quarters going forward. And I believe it's actually going to have a big influence on shaping the geopolitical balance of power between Moscow and the anti-Putin coalition. And I want to start with this little kind of tally here on the left. And this might be a surprising statistic, because we've all heard about sanctions and bans and import limits, but total Russian seaborne oil exports, and there I mean crude plus refined products, are still at about 5.9 million barrels per day. At an aggregate headline number, that is almost identical to what the average was for Russian oil seaborne exports before all of this started. So that tells us that from the global kind of aggregate view, yes, so far it is only a big reshuffle that's taking place and not yet a removal, keyword being yet. But I think that the regional and the trade level storylines behind this reshuffling are critically important for us to understand as we think about the future of the market. It's probably not the most sophisticated trade flow map you've seen, but the biggest component of the reshuffle that we're observing right now is the swap in destinations for Urals crude, which is Russia's #1 kind of flagship crude grade, between Europe and Asia. That's the first big message that I want y'all to keep in mind. Because before the war, almost all Urals crude flowed to Asia, substantially 90% of it. That's dropped to 56% since the invasion and some of the consequent measures that governments have taken place. And since the war, what's been going on with these buyers in Europe? They have turned away from Russian crude oil for a couple of reasons. One of them that we've all read about is this so-called self-sanctioning, this sort of unilateral, each company or entity at a time, deciding to turn away from buying particularly spot Russian cargoes on the spot market, to reduce their reputational risk. And of course, they're also thinking about transitioning to what's coming next. And now, a few weeks ago, we have this so-called 6th round of sanctions against Russia from the European Union. And remember, everything there has to be unanimous, where they've decided to wind down purchases of Russian oil for crude oil at the end of this year, refined products beginning of 23. But those sanctions have not really taken effect yet. So just as an example on kind of a regional basis here, and if you know your geography, you can follow my crazy lines across the screen, the Baltic refiners in countries like Sweden and Finland and Poland that take a lot of Urals crude oil from Russia, they were the top recipients in the Baltics. They've stopped purchasing Urals pretty much altogether on the spot market. Some of the trading houses have as well that deliver Urals from the Baltic ports of Russia to Northwest Europe. And it is true, just a caveat, the Mediterranean, which of course includes a lot of European destinations, is still the #1 region that's receiving these Russian Urals cargoes. Part of this is an uptick in Turkey that is new since the invasion. But to be fair, Italy is still the #1 country in the Mediterranean basin that's receiving these cargoes. So you've got a flood of discounted Urals that has to go somewhere, ostensibly, and the region that it's going to is Asia. And Asia previously received only about 7% of Urals volumes. That has surged to 37% 755,000 barrels per day. And by far the number one country that's flagged, that's on the radar here as a new recipient is India. India is taking about 30% of the Urals, about 600,000 barrels per day. It's the Urals to the Asian region. Pre-war, India just took 2% of this trade flow, about 30,000 barrels a day. So now they're at 600. That's 20 times more than they were taking before, albeit from a very low baseline. China is also taking some Urals, about 175,000 barrels a day. And of course, for another crude, a Pacific crude called ESPO, China is now taking substantially all of it because some of the other buyers in the Far East have turned away. Urals is being priced so low that some traders have shipped it direct from the Gulf of Finland all the way to China on what we call Aframax class oil tankers. Those are the smallest capacity oil tankers in the fleet. And normally that would be completely uneconomic to do a long haul route on Aframaxes. But the fact that it's ticked up like this on my time series here is a very strong indicator and kind of affirmation of how low Urals is being sold for, FOB, kind of like at the point of loading in the Gulf of Finland and in the Baltics. It's so low that it's worth it to even load these very small, relative to a supertanker, and take them all the way to the Far East and to India. See if I can go back one. So as a result, what is Europe going to do? And what's being changed in the Asian markets is other crudes, like from the Mideast Gulf and from the Atlantic Basin, are being squeezed out of some of the Asian markets, and of course are being redirected to where they need the substitution, which is in Europe. And so a few examples of that. There's some North Sea grades, like Johan Sverdrup and 40s. Those used to almost go to Asia, but now they're almost all going to European destinations. If you think about the Baltics, it's similar freight economics, same basic routes, and or at least distances, and very similar crude qualities, those two that I mentioned, to the Urals, which has kind of disappeared for Asia. Mideast grades as well, as I mentioned, grades like Arab Light, the Basra and Kirkuk grades from Iraq, those are arriving to Europe in greater volumes than before. Just as an example or an anecdote, in May, the European company Total Energies imported 2 cargoes of crude from the United Arab Emirates, and Repsol did similar, 2 more cargoes to Spain earlier this month in June. Those were the first cargoes of UAE crude to Europe since December of 21. So that's a real shift that's taking place in terms of these long-haul movements from the Gulf to Europe. Also, more grades from West Africa have recently sailed to Europe, especially Spain. And likewise for United States crude. The trend for US crude exports generally has been fewer to Asia and more to Europe since the invasion. Now I know this chart is really busy, but it illustrates the changing market share in India since the invasion. This is the supply from various supplier countries to India. And the dark purple series that's kind of in the middle of these columns is Texas. So I circled Texas and I highlighted it here because, just as a side note, since we're sitting here in energy capital of the world, in Houston and in Texas, think about how much has changed in the world oil market just since the export ban was lifted in 2015. You often read these articles saying Texas and the Permian Basin are similar in output to an OPEC country, or one of the major exporters in the world that's supplying the oil purchasing countries. I mean, look at Texas's literal position in the legend here. Saudi Arabia, United Arab Emirates, Texas, Kuwait, and the rest. And so that is a really important change. And the 3.5 or so million barrels a day that the United States exports from Texas and Louisiana are a really important part of this equation. Also, think about other oils that come out from Texas from farther away, including Canada. So you have grades like Access Western Blend and Cold Lake that are exported via the Gulf Coast that are also part of this Texas chunk here. On the way to India has really shrunk in the months since the invasion. Also lower you can see is Mexico, which is sort of the salmon colored series. And of course, the big gainers, as we already discussed, on the way to India are Russia, Black Sea, and even bigger, Russia, Baltics. Okay, this is another really important message, is that the amount of Urals that are kind of out there on the high seas, we call this the oil on water indicator, are triple their previous level, 3 times larger than what they were before. You see it tailed down just slightly in the last few days, but that could be more of an anomaly. One reason is obviously there are longer voyages of Urals to Asian markets than there were to European markets. That's very straightforward. We just talked about Baltics to India. But also note the proportion of cargoes at sea with undetermined destination. That's that large kind of purple column that emerges toward the recent times. That hardly existed before the war, and it now constitutes fully 1/5 of those cargoes of Urals crude that are at sea. This indicates, in my assessment, a desire to keep cargoes and their destinations discrete for a little bit longer, maybe as long as possible. And by the way, on this front, we're also seeing some other practices, measures, some would say trickery, dark trade tactics. We see more ship-to-ship transfers. We see more interruptions of the location signals that the ships are transmitting. And we see more reflagging of oil tankers that were previously Russian flagged. I think close to 30 of them have been reflagged to other countries in the last couple months. These are all tactics to obfuscate Russian origin. I know we have short time here. I want to give a quick comment on refined products. The so-called clean products like diesel and gasoline. There again, volumes are really very close to before. 1.7 million barrels per day in the year before the invasion. The split was 69% Europe and 17% to Asia. Since the invasion, it's held in pretty well, 1.56. It's almost 1.7. But the Europe to Asia skew is even greater now. Now it's 73% Europe, 12% Asia. And there, I think you just have a question of scarcity. There's just less diesel, they call it gas oil over there, to go around than they're able to find substitutes for, which they're doing with crudes like Urals. It's also interesting to note, for those of us in the trade, that the charterers have changed to a certain extent. Some European companies, BP, Total, Neste, those were guys that were really active in the clean imports from Russia before the war. They have largely, not 100%, but largely gotten out. And again, offsetting that, there have been some other lesser known, some would even say shady trading entities that appear to be moving some of these clean fuel cargoes out of Russia. So again, there's a lot of information on this slide. We can maybe cover it in the discussion, but I just want to kind of close with a couple remarks here. As I said before, the key question in my mind is whether these Russian oil flows are only reshuffled. The reshuffling is definitely taking place. Are they only going to be reshuffled, or are they actually going to be removed to a material extent from the world oil market when the EU ban takes effect later this year and beginning of next year, and potentially when some other harsh measures are adopted by the coalition that's confronting Moscow on the war. So fast forward to this implementation ban. The entire 4 to 5 million barrels a day of Russian oil, crude and products, that flows normally to Europe pre-war, it can't all be absorbed by Asia. It can absorb a lot of it, but not all of it. And so the key question is how much is going to be absorbed and how much is going to remain unabsorbed and unpurchased. And that supply is going to be ostensibly off of the free market. Either it's going to be produced and stored until conditions change, or Russian output is going to be reduced at the fields, or some combination of both. I've been studying a high absorption scenario. Let's imagine 2/3 or more find homes and buyers, and also a low absorption scenario, maybe only 1/3 of that incremental volume finds buyers. The high absorption, I think, benefits Putin. It maintains significant oil revenues, even though they're being sold at a discount. Under that scenario, Asian buyers in China and India continue to benefit from stable flows at heavily discounted prices. And under that scenario, I do think Europe will find adequate substitutes from the other producing regions that we discussed, Mideast Gulf and Atlantic Basin. And I think in that case, prices will still be high, but the global oil market avoids a really material shortage. The low absorption scenario kind of deprives Putin of more of those needed oil revenues. It causes a massive overhang of Russian oil to potentially develop. That leads to the oil field shut-ins I mentioned, and that can actually damage the fields. In normal circumstances, that can damage the fields. The upstream pros will tell you, in the current situation where the big three oil field services providers have left, ostensibly permanently, even more so. So that should be a big problem and concern in Moscow. So here in the low absorption scenario, you actually, I think, run the risk of potentially a bifurcated market, a two-track oil market emerging, where Russian is in oversupply, and a lot of it is going unbought, and the rest of the world actually faces a shortage, and shortages of fuels as well. In this case, I would expect a little bit of a feedback loop because I'm a realist. I think that market forces will seek to exploit what would be a pretty unprecedented arbitrage. That would be, through the black market, through illicit practices like I call it oil laundering and blending of Russian oil into other products. So maybe in reality, if you're moving toward a low absorption scenario, it kind of bottoms at maybe 1/3, but then it rebounds to, I don't know, we're just talking here, maybe half of that volume remains unabsorbed. And so in that case, shady traders and their financiers would probably benefit. Legitimate and compliant traders would not be able to take part in that. So there's a lot to talk about with the rest of the presentations here, and I'm looking forward to a robust discussion following that. Thanks.
Great. Thank you very much, Clay. So we're now going to transition to Herman Wang joining us online from London. Herman, over to you.
Great. Well, thank you so much, and great presentation, Clay. I hope to follow it with something just as informative. Again, just for those who don't know me, I am the Chief OPEC Correspondent and Managing Editor for Middle East News at S&P Global. We used to be called Platts, but now with our merger with IHS, we're now rebranded as Commodity Insights. So I am going to try to share my screen, and hopefully I can do that without blowing up everything. So I get this the slideshow. All right.
Yep, we've got
All
it.
right. So, all right, that should be working. So yeah, again, thank you for inviting me to speak. So we're in a volatile market, obviously. It's always, I think it's always good to sort of examine where we came from, how we got to where we are. And believe it or not, it wasn't that long ago that as the OPEC Plus alliance began unwinding its production cuts that it put in for the pandemic, that there were actually concerns that the cuts were being eased too quickly, too much oil being put into the market prematurely while the world economy was still trying to regain its footing from the pandemic. So, Saudi Energy Minister Prince Abdulaziz bin Salman in September 2020, right around there, he basically said, don't bet against OPEC. We know what we're doing. We're in control of the market. Trust us. We've been here before. But this was 5 months after that April 2020 price war. So, maybe you can forgive the market a little bit for its trust issues. Now we're in a situation almost 2 years later, the squeeze is on. And now it's a situation where as OPEC Plus lost control of the market. And what I mean by that is that most of OPEC Plus is tapped out on what it can produce. And the gap between its quotas and its actual production is widening, as you can see on the chart on the left side there. This is exacerbated, of course, by those sanctions on Russia. But it's not just Russia. You look at the quota compliance figures on the right, Nigeria, Angola, well over 500% compliance. On the non-OPEC side, Malaysia, Azerbaijan, some of those other countries listed there. So this is a problem when you've got a market that's in search of barrels, and OPEC Plus, which is supposed to be that swing producer, really can't swing anymore outside of Saudi Arabia and the UAE, maybe a little bit of Iraq. We'll talk a little bit more about that in a second. But basically everybody else is maxed out. And, again, so there was a time when over 100% compliance, that was something to be celebrated, actually, because there's a lot of mistrust of OPEC Plus members. Would they actually cheat on their quotas as they've done in the past? Would they actually fulfill their production cuts as they said they would? Now the situation is flipped, and in the tight market, too much compliance, perhaps too much of a good thing. So, and of course, all eyes are on Russia right now as those sanctions hit, along with the insurance restrictions. That might actually be the biggest bite. Clay has already pretty much comprehensively talked about this, so I won't dwell on this too much. But this is all, as he said, it's a reshuffling of the oil, world order, so to speak. All these different oil flows, both in crude and refined products, like he's talked about, discounted Russian crude going to China and India, muscling out some of these other producers, including their OPEC plus peers, Saudi Arabia, for example, Iraq, Kuwait. And then on the refined products as well, we're seeing fuel oil export from the Middle East into the US and to Asia, competing against the high LNG prices there. So a real reordering of how things are going, as Clay mentioned, which brings me to my next slide, which is about intra-OPEC plus competition. We hear a lot about OPEC versus US shale in the battle for market share. But there's a lot of market share competition within OPEC and within OPEC plus. A lot of that is playing out in Asia, the key demand growth center. So you can see from the chart on the right in terms of crude properties, Russia's Urals crude, their key export grade, on the sour side, heavier sour side, roughly fungible with Arab Light, Kuwait blend, Iranian Light. This slide here, I've taken this from our periodic table of crude, which is something that we have developed to categories. I think we got 150 crudes on there. We're categorizing this according to light, heavy, sweet, sour. The heaviers are toward the bottom, lights are toward the top, and sours are towards the right side. This is a free thing that we've developed on our website. Just Google it up, the periodic table of crude. With S&P Global, you'll find it. Click around on it. You can see different regions, what crudes are there, and basically what the crudes are around the crudes that you're looking at. Those are the ones that can be substituted. And so you can see that the Middle East crudes skew heavier and sour. And so Russia is discounting its crude to keep its exports up. That undercuts a lot of these OPEC plus member exports. And this is a dynamic to watch as we near the end of the OPEC plus cut agreement. Where the cuts are set to expire in August, and the alliance has to decide what to do about their declaration of cooperation, what the future of that is going to look like. And President Biden is trying to influence that process. As Mark mentioned at the top, he's visiting Saudi Arabia, or set to visit them July 15th, I believe. It's like an extreme version of snowbirding. He's going to enjoy the sun and heat of Jeddah in July. Obviously, there's some repairing of the U.S.-Saudi relations to be done there, and oil has been at the heart of those relations for decades. And as we've gone into the situation where even before the Russian invasion of Ukraine, we were facing growing demand, a tightening market. The Biden administration has, urged, chided, cajoled, finger-wagged OPEC and Saudi Arabia to pump more oil. And so Biden's going there, and some of the talk is going to be about these oil prices and what to do about them. But the U.S. isn't the only country that has Saudi Arabia's ear. Russia is keen to maintain these ties that they forged with the OPEC Plus agreement since 2017. That has extended in many ways beyond oil into geopolitics and trade and other things. And of course, there are still some very raw feelings within OPEC. I recently talked to the OPEC Secretary General last week, and his message to me was that the U.S. is sitting on all these shale oil reserves. Maybe it should tap those if it wants more supplies instead of constantly scolding OPEC. And he's been critical of the Biden administration's push to get off fossil fuels, while then turning around and asking OPEC for more oil. So lots there for Biden to be talking about when he goes to Saudi Arabia in a couple of weeks. And all of this is coming, as I said earlier, with OPEC plus spare capacity getting really tight. Our analysts estimate about 1.6 million barrels per day of spare capacity remaining, almost all of it in the UAE and Saudi Arabia. And that full capacity, by the way, in the UAE and Saudi Arabia has never really been tested. Saudi Arabia is currently about 10.5 million barrels per day of production. Under the OPEC plus deal, they're supposed to hit 11 million in August. That's a level that they've never really sustained for more than a month at a time. So this is going to be a huge test for Saudi Arabia and the market, and also for the UAE going forward. And that spare capacity is a critical thing, especially as we're seeing a lot of attacks threatening the security supply in the Middle East. And this is another product we developed, the Oil Security Sentinel, again, free on our website. It's an interactive portal of maps and charts, and we plotted every publicly reported drone attack, missile attack, mine attack that's targeted energy or shipping infrastructure. And we're updating this quarterly. And so, just a few hours ago, we got word of a potential attack on a gas field in northern Iraq. And, there's a lot of geopolitical tensions around the Middle East. And so this is something that we need to keep an eye on. And it's not just the Middle East that we're tracking in this Oil Security Sentinel. Some of the other items, Venezuela under U.S. sanctions. We're entering hurricane season, expected to be an active one, according to NOAA. Nigeria, a lot of sabotage of its pipelines from militants. Libya is one we're watching really closely right now. Production way down as different factions vie for control of their oil fields and ports. And of course, the Russian war. And I haven't mentioned Iran. Seems like we've been waiting for a new Iran deal forever for now. Lots of false starts and setbacks, but if a deal can be reached, and the longer we wait, the prospects of that seem more and more tenuous. Although the various parties are still talking, there's a lot of potential Iranian crude that can hit the market, maybe 1 million barrels per day or so within a year or so. And again, that intra-OPEC plus competition, who might those Iranian barrels displace? Add in the geopolitical dimensions of that, and you can see why this is something that OPEC is closely following. And then I'll just end with a couple slides just showing how OPEC's world has changed. They used to meet twice a year in Vienna. This is before any of us were worried about social distancing, and all the journalists would crowd hotel lobbies and the secretariat to shove our recorders in the face of these OPEC ministers and ask them about the market. And, a lot of hours waiting around. Sometimes you need a diversion. I'm going to embarrass some of my OPEC plus correspondents rivals here. You get a little bit of eye candy sometimes. Sadly, Ecuador is no longer a member of OPEC, so this is a very short-lived treat for some of these reporters. But just embarrass them a little bit. Everything lives forever on the internet, though, so let that be a lesson to us all. But now, of course, everything's virtual, which has some benefits, like being able to meet monthly instead of semi-annually. A lot easier to do that with online meetings, as we've all come to know from the last couple of years, although maybe less bullish for jet fuel demand. But the trade-off is that, as we've experienced, you lose that face-to-face interaction, the face-to-face diplomacy. And for us journalists, we lose a lot of the face-to-face contacts with ministers and delegates. It's all done on WhatsApp now. So a lot of these officials, they work at odd hours, spread out all around the world. You sometimes get WhatsApp messages late at night from a delegate, and you get a ding, and maybe your wife goes, "Who's that?" And you say, "Don't worry about it, just some guy in Baghdad. Go back to bed." And that's just how oil diplomacy is done now, and oil reporting is done on the OPEC side. So I'll leave it there. As you know, we've got another presentation and some Q&A. And so thank you very much, and I look forward to discussion.
Thank you, Herman, and I can personally attest to the great value of the periodic table of crude oil, having used it many times. So, Ben.
I want to say thank you to the Baker Institute for having me. And I'll get this pulled up in just a second. My name is Ben Shattuck. I'm Director of Company Coverage in the Lower 48. I've been at Wood Mackenzie. I've been following tight oil and shale in some capacity for the better part of 10 years now. And it really is now more than ever that corporate decision-making and capital allocation are the binding constraints on what the shale patch will ultimately produce. So I've just got a few comments on where the industry is today. Clearly, we're in a little bit of gridlock. So we'll talk a little bit about why we aren't seeing a different response from tight oil producers, and then ultimately what would need to change in order for us to grow at a rate more similar to what we did last decade, although we don't envision a scenario when that is happening. I think this slide is an interesting snapshot to start out with. The way to read this thing is along the horizontal axis is the average oil price in a given year, and then the vertical axis is how much oil we grew or shrank by onshore U.S. in that year, you can see that for all of last decade, there was a pretty tight correlation between oil price and output from the shale sector. We did this last year actually with rig count. It was very similar as well. Now I've circled 2021 and 2022, so last year and this year. These are outlier years. These are representative, obviously, of unprecedented circumstances within the space, but they also represent a shift in mindset that we think is structural in the sector moving forward, and so they will fall outside of the pack. I'll explain what that shift in mindset is before we get back to what we would call a new normal in the relationship between oil price and output. You can see then a much tighter cluster in 23, 24, and 25. Last decade, and I would actually say a couple things about this. So it's a little bit of a myth that that the U.S. isn't responding. Obviously, the rig count has increased. We'll look at that a little bit. But if you look at 2022, it sits in line or above, 4 of the years that we had in the second half of last decade. Now, why won't we go back to growing like we did at 18 and 19? So the further up we are on this, the more we grew in that year. Those were years when the industry collectively outspent cash flow by 30 to 40%. And that's why we came into this decade with effectively a financial hangover. After years of talking about capital discipline, we started to see some of that being implemented in the end of 19, coming through 20. Of course, the world changed in 2020, and we've moved to a situation now where instead of spending 130% of 140% of cash flow on an annualized basis, investors said it would be great if you could get to 70 to 80% reinvestment rate. In the first half of this year, tight oil, obviously aided by stronger oil prices, spent somewhere in the range of 35 to 40% of operating cash flow. At the end of this, we'll look at what they did with the rest of that, but you all know the story on increasing dividends. We've got dividend instituted, variable dividends, special dividends, obviously a number of buyback programs announced even this week alone. Investors want every single penny of excess cash flow given back to them after a decade where that largely did not happen. But if we are to change this, and if we are to move up on that chart and to grow by more, who do we need to look at? What's happening? You can bucket the companies that produce tight oil, rudimentary admittedly, into 3 buckets here. We've got the privately owned companies. If anybody's been following the space, you'll know that privates have grown at an order of magnitude faster than the independents. They're not bound by public equity mandates. Also building some PDP, probably, hopefully, want to be sold. But lastly, it's just plain good business right now to drill oil wells at $120. Nearly every well in every field works. The issue there is it's only 23% of supply online. So it can grow by a whole lot if it would like to. But in terms of looking for an overall U.S. supply response, it doesn't make as much of a difference. The next line down is the majors. The majors largely are on pre-pandemic trajectories with respect to growth. I think Exxon did come down a little bit on its target. Chevron has not. They will drive growth primarily out of the Permian Basin, but again, an overwhelmingly small overall percentage of lower 48 supply. So if you really want to change the trajectory of what we're doing, you have to look at the light blue wedge, and that is the independents. And like I said, we've gone from a world where we're spending 130% of cash flow to 30 to 40%. Where that ultimately lands will be what changes our trajectory. It will be the fulcrum that changes our trajectory. I think it's the last slide that I have for you. I'll talk about what could eventually change that moving forward. But that's 2/3 of the market right there. And so that's where we'll spend a lot of our time focusing. Now, one of the advantages that the private and the majors have had with relation to the independents is they've grappled with inflation a little bit better than the independents as a whole have. The chart on the left here shows the annualized budget. So the further to the right a company is, the bigger its budget. You'd expect Exxon, Chevron, Conoco to have larger budgets. The further up on this chart that a company is, the higher its inflation assumption for this year will be. So there's a very real component to scale as it relates to not only purchasing. Now, some of this has to do with Exxon and Chevron buying so far out in advance, but also the logistical constraints that come along with turnover in the industry, and with being able to negotiate longer-term contracts with suppliers that themselves are dealing with big questions. Privates have been subjected to inflationary pressures as well. They've done a better job, we would say, of retaining their people, but also started to grow from a smaller base. And so it's a little bit easier to go from 1 rig to 2 rig or 2 rigs to 3 than it is if you're an independent and go from 10 rigs to 15 rigs. So inflation is on the mind of management teams at the moment, because a well that a year ago, if the price of oil was, I don't know what it is now, $105, would have been let's call it 120% rate of return. If all of a sudden you're looking at 20 to 25% inflation, and you have to contract that rig for a year, and you have to bring some people back into the business who maybe aren't as good as what you currently have, it becomes a very easy decision for a management team to go, you know what, every time we buy back, our equity runs. Every time we do a special dividend, our equity runs. That's where we're going to go with this. It's very simple. So that's the impact that in the short term inflation is having on the sector. I put this slide in here for you. Mark has written, if you haven't read them, a series of great pieces on the role of drilled but uncompleted wells, and the role that they've played through various cycles in the shale patch. So we'll start on the right-hand side of this slide. DUC is a drilled but uncompleted well. I imagine we're all familiar with what DUCs are. But sometimes a company drills a well bore, and for whatever reason, often financially, it chooses not to complete these wells. But the drilled cost associated with that is, or the drilling cost associated with that is sunk. It's also already drilled, and that can take 2-3 weeks. If you're waiting on a rig, it can take longer than that for that to happen. During prior down cycles, this backlog of wells that you just move a frac spread on site and complete and bring to market has actually helped companies at a corporate level bridge gaps across quarters, but then that shows up at the sectoral level. The blue line shows the drilled but uncompleted backlog relative to when we started the pandemic in January 2020. There was that build obviously early in 2021, and we've effectively drawn that down to far below the average run rate on that. On the left-hand side, we're showing you the rig additions over the early part of this year. We've added about 115 rigs. We expect that to slow through the second half of the year, but there's probably still 60 or 70 rigs that come into the field. So we're not done with the overall increase in terms of activity, but similar to most years, the activity increase will be weighted to the front half of the year. In terms of how this all translates to supply in the short term, and then just a comment on the long term, we're at about 9.5 million barrels a day production onshore lower 48 today. Peak would have been March of 2020 at 10.3 million barrels a day. We don't envision a scenario where we get back to 10.3 million barrels a day until October, November timeframe of 2023. So you're looking at a full-on 3-year period to get back to where we were when the pandemic began. At that point, I haven't shown, this is a shorter-term discussion, but longer-term through the end of the decade, we envision a mid-single-digit compounded annual growth rate, so 4 to 5% between now and 2030. That obviously was going to be in the low double digits last decade, so it's a shift structurally there. Then we can get to what might change that. And I've been debating trying to explain what I'm about to explain because I'm not that articulate. The reason that tidal oil is not growing faster than it is because its investors don't want them to grow faster than they are. And the reason investors don't want that to happen is every time tidal oil grows too fast, returns are driven downward. If you were to track the XOP and an ETF that follows the energies from 2008 until today, it's in negative territory. We know what the broader market has done over that time frame. Investors, especially generalists, are myopic on a compounded annual return. The number one thing that has drawn the XOP down, it draws any equity down, is big downward movements. We all know the old phrase, if your account goes down 50% this year, you have to make 100% next year just to get back to your starting line. The only major commodity in the world that's crashed 3 times over that time frame has been oil. Largely, the oil price crashes have been associated, at least in the minds of investors, with oversupply driven by outperformance or overproduction from the shale patch. So what ultimately needs to happen then, investors need to come to a mindset where they feel that tight oil and OPEC or the global oil market can work in a less volatile manner. How can that happen? Through a consolidation of the industry. The chart that I'm showing you here shows cash flow through Q1 of this year. It waterfalls down from operating cash flow. You can see CapEx is just a fraction of that. Obviously, there's a big red box in the middle of it. We've got the net change in debt, so that's come down by $9 billion. There's only so much debt that can be paid off. There are only so many shares that can be repurchased. So the part of this wedge that will grow as these producers become even more cash rich into the future, it says cash acquisition, but it's really M&A. And when we go from a scenario where we had 150 companies to 80 to 40, you've heard some of the bigger players in the sector talk about, you need to be 10 billion in size to even be investable in the Permian in the future. We think there'll be just a handful of companies making a couple million barrels a day. That's not necessarily our view, but the sentiment holds the same, that fewer larger companies make investors more comfortable that we won't overshoot or undershoot in terms of an oil price signal, and we might get a little bit of leeway to go from 5% growth to high single digits, low double digits. It's a sustainable business model for tight oil, and ultimately is a more predictable and stable contributor to global oil markets. And so with that, I'll pass the mic back to discussion.
Great. Thank you, Ben. So we're now ready to move into some Q&A and discussion. Again, for folks who are here at the Baker Institute, we've got microphones on either side, so raise your hand and we'll get them to you. For folks who are online, we can pass questions through the Q&A function, and we can read them from here. While everyone's getting their thoughts together, I have a ton of questions, but I won't ask them all, don't worry. But I do, just to filibuster a bit, Herman, my sense is that Saudi Arabia and the other kind of key Gulf producers have worked really hard to build market share in Asia for decades, seeing it as the growth market in the future. And I've been struck by the silence that has accompanied the significant increase in redirection of Russian flows into those growth markets in Asia. You kind of hinted at some potential fault lines within the OPEC plus group, and I'm wondering if you could elaborate a bit on that dynamic, what's driving it and what to make of it.
Yeah, no, that certainly has been one of the more interesting things that as this Russian invasion has progressed, if you want to say, just the silence from these core OPEC Middle East producers on this. I mean, some of this is related to tensions between the U.S. and Saudi Arabia and other key OPEC members. But it's been interesting, even going back before the invasion. Russian capacity, Russia production was getting close to its capacity, and absent the invasion of Ukraine, they were going to get a point where they were maxed out along with the other OPEC plus members. So Russia's usefulness to the OPEC plus coalition as a swing producer was already going to be diminished. And so a year ago we were even asking the question then, what happens next? What are you going to do? And the answer that we kept getting from ministers and delegates was that Russia is a top 3 producer in the world. They came to us in a time of need back in 2016, 2017, when we really needed this alliance to come together. Now with Russia, we control about half of global oil supply. We're much stronger with them than we are without them. And even if they are maxed out, we're still going to continue this alliance and continue this management pact of the oil market. Well, now you've got the invasion of Ukraine, and Russia is obviously a pariah among most of the world now for its invasion. This has kind of put, a lot of OPEC ministers in a tough spot, diplomatically, just in terms of world sentiment. I think this explains why OPEC hasn't had a press conference since November. And they haven't, typically at the end of their meetings, even when they're meeting monthly, they will hold a press conference, kind of explain their decision, explain how they see the market going forward. And they haven't done that since November. So, just kind of sticking by, kind of keeping their heads low. They're seeing this relationship with Russia, which they spent many years trying to cultivate. They wanted to endure because, as I mentioned in my presentation, that there are ties now that have been built that go beyond the oil market with geopolitics. You've seen Russian involvement in some of the conflicts around the Middle East, and there are just some strategic ties there that go beyond oil market realities for some of these OPEC countries. So I think that's why we're seeing some silence. Now, with this market share battle going on in Asia and Russia undercutting some of these OPEC plus producers, that's going to be a really interesting thing to see how that plays out in the months ahead. And a lot of that, as Clay talked about, how much do Russian flows actually do get crimped by these sanctions? And I think that's still, jury's still out on that.
No. Again, I suppose it's easier to put up with in a rising market rather than a falling one.
Right.
We had one question from online, just very quick technical point, and Herman, you may be the best suited to answer this as well. What's the estimate of how much more Iran could produce in a, if there were to be a new JCPOA agreement?
Yeah, sure. I mean, our analysts have been looking at this question ever since they started talking about reviving the deal, a year or so ago. As they are right now, we've got them producing about 2.5 million barrels per day. Their peak, pre-sanctions production was about 3.8, 3.85, give or take. So, all things being equal, you would think that they could get that 1.3 million barrels per day back. But it's not all going to come online at once. There's been some significant deterioration in some of these fields and infrastructure just from the years of not investing in them due to the sanctions. They built up a lot of volumes in floating storage. So, I think maybe our best guesstimate is, if there's a deal and there's likely to be some kind of interim deal that gets entered into before the full sanctions relief comes in. But we'll see a lot of those barrels out of floating storage come to the market first. And then maybe we'll see, crude oil and condensate exports ramp up maybe on the order of about 800,000 barrels per day within 6 months, maybe ramping up to, 1 million, 1.2 over the course of a year. A lot of it depends on how how the deal is phased in. So, if you look at just their pre-sanctions capacity and assume some natural decline and fall off there, you could see about 1 million or so of upside potentially.
Okay, great, thank you. And we have a question from someone in our in-person audience here, please.
Howdy, John Halliburton with InSearch. Thank you, gentlemen, for your analysis and your perspective. I recall in maybe May of 2020, literally 30 days before the price for crude went negative, that there was a tsunami of crude headed our way, and sure enough, there was. Assuming that the situation in Russia and Iran can be fixed, are we setting ourselves up for yet another tsunami of crude headed our way?
I'd invite all of our panelists to join in if they want to.
Sure, thanks for the question. If I understand it correctly, then based on my understanding, I think the answer is no this time around, because I don't think there's that much spare to ramp up. If you're talking about crude that was headed our way, there was some Urals, Russian flagship crude that arrived to the United States, but it was relatively de minimis. Whereas what you had in kind of the spring of 2020, when you had this double whammy to the world oil market of economies basically shutting down because of pandemic restrictions, and also the absence of an agreement among the OPEC plus producers to curtail supply or limit supply, that led to a big overhang developing, and we saw in particular a lot of super tankers headed this way from places like Saudi Arabia. That's not in play this time around. I don't know if there's a follow-up to that.
Ben, anything you want to add in terms of a potential U.S. tidal wave beyond what you had already?
No, other than we would agree, we don't think there's a flooding, and the producer that the world had been looking to was the U.S., which structurally is about 1 million barrels a day lower than we were at that point.
And I would note that, what seems to have been behind the significant sell-off we've seen in oil prices over the last week is more about fears for a, demand, coming out, risks of recession, than it is something on the supply side. There's another question here, and then we'll go this way. No, there's a gentleman behind you, I'm sorry, yes.
Excellent presentation. All right.
Yeah.
Yes? Okay,
Hi.
thanks. Tarek Daldur Matito, excellent presentation. So if we're to go back to the last days of the Bush administration, if I remember correctly, price of oil was about, or reached for a short time, about 140 or even 150. And without supply-demand explanation, and turn out one of the explanations was that the Israelis were about to attack Iran, and then the Bush admin said, no, don't do it, and then quickly prices went down. So the question is, today, the sudden rise of price of oil, whereby within days goes up to a big chunk, is that a factor in the equation today?
Is a factor in the equation of greater volatility?
Well, yeah, of the sudden price increases. Is it a factor is that a factor in this equation now, or not really?
Yeah, I think it was, again, I invite the panelists to join in. My sense was that, back then, like now, we were looking at a period of relatively strong demand growth and spare capacity having been exhausted, as the principal drivers of the spike that we had seen back then. And the rapid reversal of it was, as we just mentioned, as a risk now, was the onset of the significant global recession, that pushed demand sharply lower. So, but other panelists want to join in?
I think that's right. I think that the primary drivers were quite similar then when we reached 147 per barrel. They were strong demand, where it had really been growing in an unprecedented rate in China in the preceding years and starting to catch up with the world oil market. The low spare capacity, which is very similar to what we have today, and then also very low crude oil inventories were a characteristic of that market. Remember that inventories and spare production capacity are the two shock absorbers that the market has against supply disruptions and to kind of mitigate price spikes. And when both of those sort of market cushions are thin, as they are today, as they were in 2007, first half of 2008, it's unsurprising to see spikes in prices and greater volatility as well.
So we were running short on time, so I've got one question from the floor, and then when you're finished, sir, I'm going to add a question that has come in online, and those will be our two final questions. Thank you.
Okay, thank you. Jim Tucker, I'm a geologist. My friends that are independents are loving the prices, but there's not a lot of drunken sailor spending going on because the costs have come up even in a greater proportion than the prices. So perhaps some of the big commercial companies, as you showed, are going to be making a lot more spending. Maybe the Nats will, but we'll see if there's any further than that. Now, 26 months ago, we ran an experiment of cutting demand 10 or 20%, and we saw the results on prices. None of the leadership anywhere in the world is talking about moderating demand and everyone cutting back a little bit. Just completely implausible things like more OCS sales opening Anwar. Is there a longer term increase, or is it we're going to zigzag along the curves you already showed? Thank you.
Okay. And then the question that's come in from online is mainly for you, Ben, I think, is with the prospects for improved productivity, in shale operations going forward, given where we've kind of come through on the cycle. So with those two questions, I want to invite Ben, since I had one specifically for you, and then see if the other panelists want to jump in on the other question as well.
Yeah, sure. So typically when we see a slowdown in activity in shale, there are some productivity improvements that are made during that time frame. Largely, those have been absent through the prior downturn. There have been one or two technologies that have made a difference on the cost side, but very quickly those have been mitigated then by inflationary pressure. So things might be a little bit worse today on the cost side if it weren't for some of the enhancements that have been made in terms of automation and simul-frac and so forth. In terms of extracting more oil per foot of pipe we put in the ground in very, very localized geographies, in plays that, smaller plays, for example, like the Powder River, we could see an improvement. It won't make a big difference at a macro level. Everywhere else, we're actually beginning to see that productivity roll over in terms of per foot of pipe put in the ground as we get into drilling more infill wells and as we exhaust the geology just a little bit. So unlikely to see a step change, but there are some minor exceptions to the rule.
Okay, thank you. And Herman or Clay to weigh in also on where we are in setting up the next set of the cycle here.
Yeah, if I understood the question correctly, it was just sort of where are there any measures to try and bring down demand? Is it to in response to these prices? Hopefully I got that question right. But yeah, I mean, I think what we're seeing a lot of the political realities of things is almost the exact opposite, right? I mean, President Biden talking about suspending the federal gas tax and asking states to do the same. Lower prices, you would think would just encourage more consumption, right? And that's sort of counterintuitive to what you would might expect in terms of bringing prices down. But obviously, he's feeling a lot of political heat with gas prices at $5 a gallon. I mean, I remember when I was still in Washington and covering the Obama administration, and Energy Secretary Stephen Chu at the time made an inartful comment in a congressional testimony that gasoline prices in the U.S. had to approach those of Europe if we wanted to actually get a handle on our emissions, and of course he was soundly criticized for that and had to walk back that statement. So just gasoline prices just seem to be such a political hot potato that measures that President Biden is talking about right now. It's not really. Of course, now we've got the Fed increasing interest rates and trying to tame inflation, and the Fed chairman testifying today saying that he doesn't see a soft landing. So we're going to be in potentially for a rough ride going forward in terms of where the economy is headed and how we get out of this high energy cost, high inflation environment.
Yeah, I'll just comment. I appreciate the gentleman's question focusing on demand. I mean, here's the reality about today's oil market compared to where we were and where we've been from the pandemic. I mean, demand has roared back with a vengeance, and supply has not rebounded in kind. You don't have to be a PhD economist in energy to know what happens next. I mean, prices are going to be higher. So that's right. So, and that's also why I think a lot of the observers are saying kind of the next inflection point that is liable to moderate prices is demand destruction, or at least a turn down in demand. So it's some pump price, and it's some price of the goods that are built into the diesel haul that all these companies are paying for to get goods from factory to market. There will be reduced spending. And so on paper, that's the economist's answer for probably what happens next. For its part, the International Energy Agency has certainly emphasized the need to control demand and to try to moderate it. They've been out there pounding the table on that. Not a whole lot of politicians in many capitals are listening. So we've got this inflection point coming up at the end of the year that I talked about, which is on the import bans and stuff on Russia. There's another really important milestone coming up here toward the end of the year, which is midterm elections. And so to my colleague's point, to Herman's point, the thing that concerns me most of all in this environment is the propensity for politicians to adopt short-sighted policies that may backfire and produce unintended consequences and actually wind up hurting consumers and businesses. I'm on the lookout for stuff like that, unfortunately.
Mm-hmm. So, there's a bunch of more questions in the room, and I'm afraid we can't get to them and still honor our commitment to get you out reasonably close to on time. So let me just wrap up briefly. First and most importantly, thanks to the great team here at the Baker Institute for all the work that they've done to put this together, and to provide you with the free lunch, and for which I guess you've paid by having to suffer through this conversation. For the people in person, at least, and Jane, thanks also to each of you here with us today, as well as people who've joined us online from all over the world, for taking time out of your busy day. We hope you found this to be a useful conversation. I can't tell you what I pay for a gallon of milk, but I can tell you to the 10th of a cent what I pay for gasoline. It's the only thing we buy where the price is screamed at us from every street corner in foot-high letters, and it has a huge role in our lives and in our pocketbooks and our business bottom lines and our elections and our geopolitics. It is the reason why we're all here today. Hopefully, you come away, if not with the ability to predict the future price of oil, and if you can do that, please consider making a large donation to the Baker Institute. But at least an understanding of the issues that we face and some of the key things to be watching, as we head down the road. Speaking of heading down the road, I should turn you all loose, so please join me in thanking our panelists for a conversation today.